Welcome to Asian Economy Channel. I'm Antony. U.S. authorities have recently signed the Fiscal Responsibility Act, which has temporarily resolved the debt ceiling issue. This has helped avoid a catastrophic impact on the U.S. economy and financial system. However, renowned economist Nuriel Rubini emphasized in a media interview on June 4th that the prolonged debt ceiling crisis has caused significant damage to the U.S. dollar and U.S. bonds. It has eroded the confidence of U.S. debtors in their ability to repay their debts. As a result, global central banks have accelerated their accumulation of U.S. treasuries, further propelling the process of global dedolarization. Rubini cautioned that the resolution of the debt ceiling crisis is only a temporary measure, and the magnitude of the crisis could worsen. The U.S. Treasury may need to raise $1.6 trillion to balance spending and debt service, which could potentially trigger a recession and bank failures, further tarnishing the U.S. financial reputation and the status of the dollar. Jamie Dimon, CEO of J.P. Morgan Chase, also noted in a letter to shareholders that the U.S. banking crisis is far from over and will continue to have repercussions in the coming years. He specifically highlighted the vulnerability of shadow banks with low risk tolerance, suggesting that they may face a crisis at any time. Barclays Bank commented on June 4th that the global push for dedolarization is undermining the dominance of the dollar. The ongoing U.S. debt ceiling crisis and the escalating banking crisis have eroded global trust in the dollar, particularly in the realms of petrodollars and digital currencies, which serve as pillars of the dollar supremacy. In a report dated May 29th, Peter Schiff argues that oil-exporting countries heavily reliant on the U.S. dollar for settlements could explore innovative foreign exchange systems and introduce gold-backed digital reserve currencies as alternatives. This would help reduce or circumvent the influence of the dollar within the context of reshaping the global financial order. Iran is currently developing a new digital currency backed by gold, which would establish an exchange rate based on the value of international gold, rather than the Iranian rial. This would enable other countries to conduct cross-border transactions without relying on the U.S. financial system, thus bypassing U.S. regulatory authority. It could serve as a payment method for the Iranian central bank to facilitate cross-border transactions. Presently, 4 Iranian banks are engaged in discussions with Germany, Japan, France, the United Kingdom, Switzerland, Austria, and South Africa regarding the use of digital currencies in commodity settlements and financial transactions. Iran's SHTA trade facility with Switzerland has already conducted several transactions that circumvent U.S. dollar settlement. Moreover, Russia, Iran, and India have commenced exploratory discussions on utilizing gold for oil trade. Iran's central bank launched a new currency exchange center in April of this year, enabling the use of foreign currencies, including the yuan and euro, for direct gold trading. The Central Bank of Iran has stated that promoting Iran's access to more gold is one of the center's key objectives. Gold plays a crucial role in facilitating Iran's export mechanism. Iran has imported a record amount of gold in the past 3 months, allowing companies to settle export-related expenses, including oil, using gold. This approach allows exporters to bypass U.S. restrictions on Iran's access to the international banking system. On June 2nd, Iranian Oil Minister Javad Raji announced that Iran's total oil exports have reached 2.23 million barrels per day, the highest level in 5 years, with a significant increase in oil supplies to East Asian markets. This surge is attributed to new changes in the settlement methods for Iranian exports. According to data released by energy consultancy SBB International, Iran's average daily crude oil exports in May reached 1.1 million barrels, the highest level since last year. Notably, Iran shipped approximately 800,000 barrels of oil per day to China, representing a 20% increase compared to the previous year, and it is anticipated that China's oil imports will continue to rise in the coming months. Data from energy shipping data firm Vortexa and Kepler reveals that at least 28.5 million tons of Iranian crude oil arrived in China over the past 24 months as of May 31st, with the majority of transactions settled in yuan. Separately, Iraq, a significant oil-producing nation in the Middle East, announced a few weeks ago that it would settle trade with China in yuan instead of dollars. Additionally, the UAE plans to establish an offshore digital yuan hub in the Gulf region. In a report on June 2nd, McGill International recommended that Middle Eastern oil exporters, such as Saudi Arabia, Iran, Iraq, and the UAE, convert a portion of their oil revenues into gold to support a global digital reserve currency system backed by gold through the Shanghai Gold Exchange. According to a recent report by Zero Hedge, Japan Customs has entered into talks with Iran regarding the use of digital currencies in energy and financial settlement transactions, with the intention of bypassing the US dollar in Iranian oil trade. They aim to establish a cross-border settlement system that facilitates digital currency payments. Furthermore, the World Gold Council's report on May 30th showed a significant increase in the inflow of money into Japanese gold ETF funds and trading in the Japanese gold market since April. This suggests that Japan, the largest creditor of the US, is not only accelerating the sale of US debt by increasing its gold reserves and normalizing its monetary policy, but also planning to use digital currencies to diminish the influence of the petrodollar in its oil trade with Iran. The Zero Hedge report indicates that with the US banking crisis continuing to spread and US financial credit risk on the rise, major buyers of US debt at the global central bank level, including China and Japan, may progressively reduce their holdings of $700 billion in US debt to mitigate their exposure to the US. Consequently, they are following the trend of global central banks selling US debt and increasing their gold reserves. These developments could once again position gold as a trusted anchor for establishing a global digital currency system parallel to the US dollar. These global digital reserve currencies would facilitate direct connections between an increasing number of global central banks, bypassing the dollar-centric system. This explains why China is following suit with global central banks by intensifying its gold holdings as an international reserve asset. The latest data further reflects this trend. Based on data released by the World Gold Council on May 20th, China imported 178 tons of gold in March, bringing the total imports to 422 tons in the first quarter, marking the strongest quarterly performance since 2015. Switzerland shipped 308 tons of gold to China in the first 5 months of this year, a 71% increase compared to the same period last year, according to data released by Swiss Customs on June 1st. Additionally, the latest data from China's central bank reveals that the country increased its gold holdings by 66 tons in the first quarter, bringing the total gold reserves to 2,076 tons. According to publicly reported data from the World Gold Council, Swiss Customs, and the Chinese Central Bank, at least 796 tons of gold had been delivered to China in 2023 from 3 international gold markets: the United States, the United Kingdom, and Switzerland, as of May 31st. Thank you for watching this video. I hope my analytics was useful for you. Like and subscribe, please.